Dear friends, welcome to our monthly video on markets and more. After a torrid pace of the rise in Nifty post the passing of the Union Budget on Feb 1, the last few days we've seen quite a flutter both in global and Indian markets. And the big worry point or the talking point has been the rise in bond yields. The US 10-year GSEC yield has risen by almost 100 basis points since the lows it showed in August 2020, where it was only 0.5%. The movement has been somewhat very sharp in the last 1 month, with bond yields spiking by almost 50 basis points in the month of February. Now, one of the key reasons behind the recent sharp surge in yields is the evidence of a stronger growth outlook. In the US, for example, an added 1.9 trillion fiscal package, which is almost 9% of their GDP, has been passed. The virus infections are also dropping. Vaccination has been put in play, which has bolstered the prospects of reopening and strengthening of the economy. This in turn has led to bond markets to price in expectations of better growth and rising inflationary pressures. Therefore, in line with global trends, Indian yields have also risen and hardened. For example, after the budget, which was expansionary because, as we talked about it in last month's video, that the government is now much more tolerant of a higher fiscal deficit. The 10-year GSEC yield in India also moved up by 30 basis points to reach 6.2%, despite RBI's verbal and explicit market support. So, therefore, why is the market spooked by the rise in yields? We all have been large beneficiaries of very low interest rates and very loose monetary policy. But what rising yields tell us is that, is the monetary policy tightening? Are interest rates likely to move up? And if interest rates move up, will PEs fall and therefore will markets correct? Now, let us look at the evidence. We may not have all the answers, but we certainly have history to go back to. And if we were to look at history, I think what history tells us is that equities as an asset class tend to perform well in an environment of rising growth and moderate inflation. On the other hand, if the environment to be worried about is if yields are rising and growth is slowing down, or we have what is called as in economics stagflation. But I think if we stand today where we are, I think we are probably going to see strong rebound in growth with rising inflation and hence rising bond yields. Now, if you look at the chart in front of you, for instance, there have been 5 episodes in India going back since early 2002, where we have seen sharp rise in bond yields in the last 15 years. And if you see episode 1 and 3, where bond yields went up, equities actually did well because growth was also very, very strong. While in episodes 2 and 4, equities struggled due to falling growth and rising inflation. So if you look at the table, you will see that, for example, in episode 1, which was from 2004 to 2006, when bond yields went up, the average GDP growth was 8.8%, and the average CPI inflation was only 4.5%, and Nifty gave a return of 88%. If you look at episode 2, which was from February to December 2008, which coincided with the global financial crisis, obviously growth plummeted to 4%, but inflation was up to 8%, and Nifty gave a negative 46% return. But between 2009, which is after the global financial crisis, and November 2011, growth bounced back to 8%. We had higher inflation at 9%. But despite that, because growth was very strong, the Nifty gave almost a 59% return. But again, between May 2013 and August 2013, if you remember, that was again a period where there was, the taper tantrum, where yields were expected to rise. Average GDP growth had softened and fallen to 5.8%, and inflation was running at 10%. The Nifty corrected by 10%. And episode 5, which was from July 2017 to October 2018, we had an average GDP growth of 6.8%, but again, we had tamed inflation to 4.5%, and Nifty gave positive 14% returns. So if you look at all the 5 episodes, I think what we conclude is that as long as if you have inflation, but if it is matched by solid economic growth, then rising bond yields are not a threat to equity market returns. And therefore, we believe that where we are today in the current cycle, in the current state of rising yields, is very similar to episode 1 and 3, where the growth was very strong and that led to rising yields. So I think in terms of the current flutter that we are seeing in the bond markets, both globally as well as in India, I think we can take solace from the fact that we are likely to see far stronger rebound in growth, and therefore the yields are just pricing that in. Because let's be very frank, I mean, if economic activity levels is going back to pre-pandemic levels, why should bond yields not go back to pre-pandemic levels, right? And if you look at the US Treasury, it used to be 1.8, 1.9% before the pandemic. It went to a low of 0.5%, only 0.5%. And now recently it has rebounded to 1.6%. And yes, there has been, and we think that there will continue to be, central bank intervention. But the fact of the matter is that if the US economy and global growth rebound very strongly, then yields will reprice themselves. And I think the markets will go through a phase of volatility because it is trying to price in this higher growth. But as long as we are confident that growth is strong, we shouldn't worry about rising yields. So, having said that, as I mentioned last time, that we were very, very constructive on markets in general. And, despite the occasional corrections that we may have, like the scare that we saw in terms of rising bond yields, I think one of the very fundamental reasons why we remain confident about the equity markets is because there is great earnings support. And we got to see that in the Q3 earnings. The earnings season is over. And if you look at the numbers, then the Nifty companies reported a 21% year-on-year growth in profits in Q3, which is a multi-quarter high despite, flat top-line growth. More importantly, the breadth of profit growth was very encouraging, which most sectors, especially the cyclicals, posting a double-digit growth. This is attributable to both receding credit costs in financials, cost rationalization across sectors, leading to a 380 basis point improvement in EBITDA margin expansion, market share gains from fragmented unlisted players, and resumption of pent-up demand. So if you look at the earnings picture, it gives you the confidence that there are legs to the equity market strength that we have been seeing over the last couple of months. If you also look at the upgrades to Nifty earnings in FY22, you will see that we continue to see very strong upgrades. I think there has been on an average 8% upgrade post the Q3 results in Nifty earnings, with cyclicals seeing the sharpest upgrades amongst all the sectors. So if you look at industrials, consumer discretionary, oil marketing companies, banks and financial services, metals and mining, and exporting automobiles, you will see that those sectors have seen the maximum upgrades, while telecom, agrochemicals, consumer staples, utilities have seen downgrade post the Q3 numbers. So I think finally, as I had mentioned last time, that we continue to remain very constructive on equity markets. Yes, there will be occasional corrections, but as I had mentioned last month, and I repeat, that we see a very strong economic growth followed by reasonably strong broad-based recovery in the return profile of the markets. And therefore, we continue to be confident, and I think investors should not worry too much about some of the hiccups that we may see along the way, like we saw last month in terms of rising bond yields. So thank you, friends, and we will talk again next month.